We don't worry about whether a stock is small cap or large cap, except to the extent that by now we've gotten to a point where anything below a certain level just is not of interest to us because it can't be material to our results. So
there's something really important to realize with what Warren Buffett is saying here. The fact is that small-cap companies are excellent investment opportunities and should be truly utilized by investors, especially with smaller capital. In other words, you. It's common knowledge that small caps actually bring back a better return on average than the general market and larger capitalized companies that investors like Warren Buffett stick to. Buffett manages enormous amounts of capital through his company, Berkshire Hathaway. As his investment holdings have grown over the years, it has become increasingly challenging to allocate significant amounts of capital into smaller companies without significantly impacting their prices. The sheer size of their investments limits their ability to invest in smaller companies without causing substantial market disruptions. In this video, we will explain how to take full advantage of this fact. Amazingly, you can outperform Buffett year after year, and it all starts with this. The key to gaining the title of Best Investor in the World was done through Warren Buffett's style of investing. He uses what is called value investing. There are 4 main pillars to value investing. Mastering them will enable you to make intelligent choices, leveraging the appropriate small caps, and potentially generate higher returns than those achieved by Buffett and Munger themselves. So, what are the pillars? The first pillar is understanding the business that you're looking into.
What kind of businesses am I going to find like that? Well, I'm going to find them in simple products, because I'm not going to be able to figure out what the moat's going to look like for Oracle or Lotus or Microsoft 10 years from now. I mean, Gates is the best businessman I've ever run into, and they've got a hell of a position, but I really don't know what that business is going to look like 10 years from now. And I certainly don't know what his competitors' businesses are going to look like 10 years from now.
While some people may rely on using all sorts of complicated methods to find a business, it really should be quite simple. Start off with things that are already present in your daily life. For example, what phone do you use? Is it Apple or Samsung? How about the shoes or clothes you're wearing? Do you wear Nike or Adidas? Maybe Lululemon? What about the car you're driving? These are all businesses that are already very present in your life as you use them every day, and you can give a really good retelling of how good quality the products are since you use them so frequently. In fact, this is the method that Warren Buffett's student, Mohnish Pabrai, uses. He continues by saying that once you take some time to find these companies and dig into their history and information, look for those little bits of information that stand out to you that other companies don't do. For instance, like Coca-Cola's or Ferrari's brand name. That alone gives them a huge edge over every other competitor. Following Warren Buffett's advice from the clip before is to stay within your understanding. Buffett said that even though Microsoft is in an excellent position, he refuses to invest in the business simply because he doesn't know enough about it. From here, we can move to the second pillar, which is looking for businesses with a competitive advantage.
It's not an easy business. I don't want a business that's easy for competitors. So I want a business with a moat around it. I want a very valuable castle in the middle, and then I want the duke who's in charge of that castle to be honest and hardworking and able. And then I want a big moat around the castle.
The term for a competitive advantage is often called a moat. For those that don't know, this is an old term used as a defense for a castle against attackers. It was usually a huge ditch that was filled with water. In the business world, it's a company's defense against competitors trying to take them down. Now, it's important to know that the company can sometimes be the company name itself, but it spans far beyond that. Essentially, when you look at a company, you want to find the obvious standout thing that makes the company survive. For example, a MacBook is like no other laptop around and constantly delivers for people who are more artistically oriented. Or, one of the 2 most common toothpastes are Crest and Colgate. In fact, when you think of toothpaste, chances are it's one of these 2, and that's exactly what a moat is. These are companies that will continuously have value over time. A great indicator for checking whether a company has value over time on top of a moat is its management team. You're not looking specifically at the manager and their personality. You're looking to see whether what they've promised actually follows through. A way to do this is, instead of looking at the most recent reports, to look at ones from the past, like 10 years ago, and see if they've reached the goals they said they would. For example, if they said they would increase their profit by 10% in 5 years, then go forward 5 years and see if it actually happened. That will tell you most what you need to know about management. Another famous quote to remember is from Charlie Munger. Invest in a business any fool can run, because someday a fool will. Again, we see that a business should be simple and easy to run because that's what it'll give it longevity. The complex seems impressive, but it's not easy to run and is prone to failure. While it's good to know the business you're investing in, knowing they have a strong moat and management team, there's still one more major piece of information to understand, and that's the intrinsic value of the company.
So I want a simple business, easy to understand, great economics now, honest and able management, and then I can see about, in a general way, where they're going to be 10 years from now.
The intrinsic value of a company is what you believe the company should be worth. That means whether the current price is worth more than the company or worth less. When it comes to value investing, you're always looking for companies that are worth less. There are many ways to figure out the intrinsic value, but there are 3 commonly used methods. The first is to use a discounted cash flow analysis, or a DCF. This method projects the future cash flow of a company and then discounts it back to the present value with a discounted cash rate. For example, let's say you want to invest in company ABC. You project the company's cash flow for the next 5 years to be from 10 to 20 million over 5 years based on its current growth. Then, you can assume a discount rate of 10% over the course of that time. You'd be left with a present value of cash flow at $54.71 million, which is also the intrinsic value of the company. The second method is using the price-to-earnings ratio. This is a very simple and reliable method, and it's excellent for beginners. What you do is compare the current stock price to its earnings per share. Then, you can compare that company with other companies in the same sector to see how it's performing. Here, you can decide whether it's over or undervalued. For example, if a stock has an earnings per share value of $2.50 and a stock price of $25, then its PE would be $25 over $2.50, or 10. If the average PE in the sector is 12, then you can assume that it's an undervalued company. The third method is a dividend discount model. This method is used to estimate the future dividend payments of a company and discount them back to their present value using a discount rate that reflects the risk associated. The sum of the present value of all future dividend payments is the intrinsic value of the company. For example, if ABC pays an annual dividend of 1.5% per share, and you assume the dividend will grow at a rate of 5% per year and have a discount rate of 10%, then you can expect the total present value to be $8.76, which is the intrinsic value of the company. It's normal to feel like these methods go right over your head, because for most people, they do. Fortunately, that doesn't mean you have to give up, as there are plenty of resources that can help. For example, you can check out stockanalysis.com, which is a free website that gives you all the information you need to do the analysis types I just mentioned. With that, you have the basics of Warren Buffett's value investing style. But what does this have to do with small cap stocks? As was mentioned at the beginning of this video, Warren Buffett, along with many other big-time investors, cannot take advantage of small cap stocks. This is because he simply has too much money and would basically buy out the company. This would completely defeat the purpose of investing in the first place, and the risk would be way too high. However, for an investor with small capital, there are some excellent options here. In fact, on average, small cap stocks grow at an annual rate of around 9 to 15%, whereas large cap only grows at a rate about 7%. This alone is already a huge edge over Warren Buffett. However, you may be wondering, what even is a small cap stock?
So we don't have huge returns in mind, but we do have in mind never losing anything.
Small cap stocks, known as small capitalized stocks, are companies that have a small market valuation. In other words, companies that are valued around $300 million to $2 billion. But this range depends on some factors. The way this is calculated is by multiplying the company's stock price by the number of outstanding shares. Again, using the website I mentioned earlier, it's easy to find small cap stocks by simply setting a filter and you'll have what you need. But here comes the tough part. You need to take the time to go over all the companies and apply what you've learned about value investing. To start with, look for companies that give services that you know about. For example, if you're an expert when it comes to clothes, then search for companies that are in that sector specifically. Remember, these are going to be companies you likely don't know too much about, but you can learn about quickly through your expertise. Once you've found those companies you resonate with and understand in terms of business, you want to see if they have that special something. For example, do they provide a service that's way better priced than the leaders in the same sector? For example, if they sell clothes, do they source them from a sustainable place and sell them at a much better price? When you can find a solid moat, then you can move on to the next step. Have a look at how the company has performed over the course of 10 years or so. That means going back to their earlier annual reports and seeing what they project and promised. Did they manage to increase their earnings by 15% in 2 years as they said they would? Did they find ways to make their clothes more sustainable and increase the number of stores? Did they start giving out dividends like they said they would? If all of these promises went through, then you're on to something. If they fell flat, then it's a firm no. If that rare company has passed this far, then you can start checking its value. Is it currently undervalued compared to its peers using one of the models we previously mentioned? Let's say that the sector currently has a P/E of 10 and this stock has a P/E of 5. This means in relation to the industry, it's currently undervalued and can be an excellent buy for the long-term investment. Now that you understand the ins and outs of the famous value investing method that's allowed Warren Buffett to beat the market by doubling his returns since 1965, it's time to share 3 small cap stocks that are becoming increasingly attractive for the reasons mentioned. Number 1, the Howard Hughes Corporation. The Howard Hughes Corporation is a real estate company that focuses on building homes, apartments, skyrises, and even neighborhoods across America. Of course, real estate is one of the most safe and reliable investment paths to take, so it's already a good start when it comes to investing in this small cap. Not to mention that the CEO of the company is constantly buying back stocks, which clearly means he believes the company is going places. Number 2, Levi Strauss & Co. Levi Strauss is popularly known for their jeans, and it's likely that many of you even own a pair or 2. That's already a good start to think about investing in this company since you have a direct relationship with it. This company is currently selling at 11 times earnings, which is excellent. Number 3, Madison Square Garden Entertainment. This company owns Madison Square Garden as well as Beacon Theater, along with many other entertainment places. Naturally, people love entertainment, and it's not going away anytime soon. In fact, people want it even more now that COVID restrictions have passed. These are all companies that Buffett currently can't buy into, but investors like you can. But do you know the best part? This is because there are only 3 out of hundreds, if not thousands, of small cap companies that you can put your money into for massive potential returns. If you want more information on great investment opportunities, then subscribe to this channel. Let us know in the comments below what your favorite small cap companies are.